Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me Darris Cassidy with Fairway America. How you doing, Darris?
Good. Thanks, Lance. Thanks for having me on the show. Excited to be here and interested to do this with you.
Yeah, no, my pleasure. Yeah, so, backstory, obviously, Darris and I are business partners. We've known each other for a really, really long time. On the Fairway America side, me, Matt, and Darris were sort of the crazy guys who, got this thing off the ground, and obviously what's led to, two really fast-growing companies in their own right. And so Darris spends his days on the Fairway America side, and my day job is sort of over here on the Veravest side. So thought we'd have him on to kind of pick his brain and figure out what's going on in the market and, the things that those guys are working on and the strategies and those sorts of things. Before we get there, though, kind of always start out with every guest is just tell me how you got into real estate. What led you to, getting into the business and maybe share too how we, kind of the story how you hooked up and we teamed up at Fairway.
Yeah, no, absolutely. So I kind of grew up in the business, so to speak. My father still to this day is a commercial mortgage banker. So from a young age, I really understood real estate finance. I mean, I was oddly fascinated with capital stacks and debt service coverage ratios and loan to value and things that, most 10 and 12-year-olds really don't care about. I had other interests as well, baseball being one of them. But, it was a way that my dad and I connected over time. And he's one of these guys that every time we went on a family road trip, he'd have to swing into some apartment building to do a quick inspection and take some photos. So I was kind of along for that ride, touring properties and understanding the math, using a HP 12C calculator before I used a graphing calculator type of childhood. So always found it interesting. Of course, he's on the debt side and over time, I met a lot of his clients that were either, wealthy individuals that owned commercial real estate, or they were developer types that, built and held on or sold real estate. And I was really intrigued by the developer side of the business. So I think that was kind of my inclination growing up, that I would go into the development side, which I did, and I'll kind of get to. So ended up going to Gonzaga University in Spokane. And during that time, did a summer internship at a commercial appraisal shop here in Portland. Palmer Growth and Pietka was the name of that. It was eventually purchased by, I believe, Colliers, bought them out. So it's kind of a runner. And when I was an 18-year-old in the business, and, back to the days when I would run around taking photos of properties and get the film developed and tape it into the appraisals. So understood appraisal from that, 18 years old, then started at a company in Spokane who is no longer around, Metropolitan Investment Securities. And interestingly, part of the show, the risk report, right? There was a lot of fraud going on there, which of course I didn't know. I was 19, 20 years old, but they were selling mortgage-backed securities. Big shop, one of the largest on the West Coast. And a lot of the executives there went to prison over things that came out after I, graduated from college and had moved on. Yeah. But so kind of understood that side of the business from that point. And then right out of college, getting a degree in finance, took a job with Home Street Bank in Seattle in their commercial real estate group. And during that job, primarily we were doing Fannie Mae multifamily loans, but we also did a number of other types of debt products for the bank. And so I was, a loan closer, a portfolio manager, a little bit of processing, kind of moved all around pretty quickly, and became apparent I wasn't going to move up as quickly as I wanted. So I was recruited by Bank of the West down here in Portland to become a relationship manager or a commercial loan officer. Mm-hmm. So during that time, I was about 23, 24 years old, focusing on doing loans 5 million and up, and including single family land development, single family homes, apartments, office, industrial, all the food groups, and had a great experience there. I was a high producer at the bank, and got into credit default swap or derivatives and various kind of unique products. And then one of my clients offered me a position to come over as originally as a controller and move my way up there. A guy named George Hale, a great guy here in town. Mm-hmm. He had a company in Bend, Oregon called Woodhill Homes. We were doing a lot of production style single family homes as well as land development. Also did some industrial assets and condominiums and multifamily apartments. So great experience there. Oversaw a lot of different entities and strategies during the housing boom. And then, of course, it all kind of fell apart. And interestingly, George and company had positioned us as well as could be during the time. We were not over levered like most of our competitors. Most of our competitors went bankrupt. We did not. So I pretty much went into workout mode we had roughly 15 lenders or so at the time, and, worked our way through that. And, as part of that, started acquiring packages of single family homes directly from banks. And it was kind of a crazy time. I remember our first package, you really didn't have any due diligence time period, about 24 hours. So, I'd stay awake all night Googling addresses and trying to figure out what I could. And of course, the internet was good then. It's obviously a lot more robust now. So couldn't find as much information as one would hope. But it was more of a mathematical play in that, you'd buy 50 homes and you'd throw 5 away or donate them to the local church, and 5 would be home runs and the rest you'd figure it out. Yep. So we started selling those on land sale contracts to create paper and cash flow, eventually stabilized a portfolio of those assets, and then sold those off mostly to investment banks as well as some private investors. So that's about the time you and I met, Lance, and whatever that may have been, 2008 or 9 or thereabouts, 7 maybe, and got to know you. And you can tell your own story about why you were subletting an office from George, but we didn't necessarily work together, but worked next to each other on our own stuff. And around that time, it also started trying things with Matt, because of course the banks were a mess at the time and we had business to do, and Fairway was a hard money lender in town, and was trying to figure out some solutions to some things. So started chatting with Matt at that time. Turns out Matt and my dad, to bring that full circle, had done business together. And then you went over and started working with Matt. And I don't know what year that was, 2008 or so. Yeah. And I stayed with George until about 2010, and then I went out on my own, continued to execute that single family strategy, as well as to do various CFO consulting work for real estate developers and help them negotiate through their bank situations, as well as start putting together equity raises on behalf of developers throughout the West Coast and pro formas and whatnot. And then you and Matt had the crazy idea that's become, we've layered on top of it, but to start advising real estate sponsors around the country. And, you guys called me up and asked me to hear you out on it. And I thought it was really interesting and intriguing, and I love the concept. So we kind of, figured out a way to have me wind my business down over time and merge myself into Fairway. And in those early days, it was you, Matt, myself, Angie, and a handful of other people. Jay, I guess, joined around that time. But
Yeah.
it's been fascinating to see how this thing has grown, to your point, to now have the two companies, Verivest and Fairway, kind of stand on their own, run on their own. You and I don't get to work as close as we once did, but of course, as kind of board members on each other's companies, that we get to do that. But I just think the story is really fascinating, the way it all kind of came together.
Yeah, it is. It's a small world, and I think you guys can see why Matt and I were hot to land Darris. He's got a very interesting sort of background and experience, and it was just perfect fit for us, right? Because that was having someone like Darris on the squad who really had seen a lot, like you said, the debt side, the equity side, executing strategies, right? So being able to go out and build relationships with, sponsors and prospective clients, obviously the finance side, the underwriting, the diligence, the modeling, all those things. We often talk about, on the show, the guests, in one way or another, it always comes back to sort of, it's a team sport, right? And certainly, it's difficult to do for one person. It can't really be a one-man band. You need to have sort of people that are really strong in their own right and complementary skills. And I think when you look at, in our case, it was Matt and myself, you and Jay, right? It's just it's very complementary, and without any one of the pieces, I'm not sure if we if we get here. Right? Like it's like you need Jay's like our backstop that keeps us grounded. The three of us are very entrepreneurial with all these big ideas, but in our own respect, sort of the skills that we have, Matt's a really great writer and he's very conservative and the underwriting guy, you're more optimistic and, kind of big picture and love the kind of a deal junkie, I guess. And, so it's been a lot of fun, but I think early on, right, it was, we brought you on, wanted you on our team because we felt like you could help us fulfill our vision. It obviously resonated with you, but it always was from really going in, end of 2011 into 2012. And when we really started to recruit UCard was, hey man, we feel like this industry is prime, the middle market real estate space to really explode. And I think that we can take advantage of it. And really our whole thing was more about how can whatever it is that we do, how can we get a flood of capital into the space and specifically to make its way to worthy real estate entrepreneurs, those who would be, good stewards of the capital and that could execute their plans and they had sort of a conviction, right? They had a strategy. They knew what we're doing. Because that's why Matt and I decided to do it initially. And I think that's what resonated with you. And you see sort of your background is you've had exposure to many things. But it was about that. It was about, hey, real estate, it cycles up, it cycles down. Some strategies, really make a lot of sense in certain things. And obviously as commercial hard money lenders, we felt like that was part of the problem is that, especially as conservative, hard money lenders on commercial real estate specifically, it's not always in favor. Now, some guys are able to do it, but we just felt like that was limiting and we wanted to do that. So I think is a good transition, right? So it kind of gives you a sense of like why we did this. Obviously, I spent a lot of time talking about kind of what we're doing at Verivest. But on the Fairway America side, maybe you can go into a little bit about you guys as investors now. And, which once again is that I'm indifferent, right? Like I don't, I just trust in these guys. These guys are more the, they have an opinion on that. I'm like the independent party here, but maybe share a little bit about the strategies that interest you right now and that you're out there looking for, that you think makes sense.
Yeah, no, that's a good segue. I mean, just to touch on a few things before I get into the strategies. I mean, what really resonated with me when we started talking about this was me as a sponsor recognizing some of my own limitations, right? As a one man, or I had a few employees, but essentially on my own, the back office and capital raising and finding the deals and then the asset management and portfolio management on an ongoing basis. So you're absolutely right about the teamwork, but also, having professionals such as Verivest to do some of that work, or even, in our strategies, and I'll touch on this, Fairway's strategies of, partnering with someone like a Fairway, and those things didn't exist in any capacity that I ever witnessed. And so we have witnessed a lot of sponsors kind of did my best, but it was not as optimized as I think we've witnessed a lot of people be able to kind of up their game since we've provided some of these services. So as far as strategies go, to your comment around Fairway being a hard money lending shop, and that kind of doesn't work through all cycles. We've definitely seen that. I mean, people are making hard money loans, and if you're leveraged and you have a low cost of capital, it can work. For us at the moment, that's a hard business. So we have the benefit of having a very broad mandate, both in our investment funds, but also in the types of syndications and deals that we do, the single asset deals, which is really my focus ever since about a year ago. And then Miranda Stiver in our office focuses more on the fund capital raising. And I, of course, sit on our investment committee, so I help decide which deals go into those funds, but I no longer raise capital for those, to be clear. And so as far as strategies go, it's definitely fluctuated over time. I think going back to 2013, we've done retail, we've done office, warehouse, industrial, self-storage, single family fix and flips. We've done some lending, we've done a variety of different things. And of course, market cycle. So you started to really see the Amazon effect, as people call it, which is a very true thing. So retail started shifting, and has been shifting. And that created some really good buying opportunities 5, 6, 7 years ago with really high cash flows because people didn't like the risk of it. Well, we could get our minds around some of that risk. And so we acquired some of that, in today's world with COVID and the continuation of technology and online shopping. Retail is just a really difficult asset to play in. And I just think that you have to, think about how you as an individual move around the world, right? And what does that look like? I mean, and you're not only you, but your family, people go grocery shopping, or they still get their hair cut, or they go to the local, little restaurant or whatever it may be. Mm-hmm. And of course, COVID withstanding. But so there are some plays there, but we're not all that active and have not been active in retail. So kind of cross that one off. Office is interesting during COVID. We're seeing, our portfolio has held up really well as far as collections in office. Cash flows have remained healthy. But that said, we own more suburban styled office buildings and not these large downtown, office towers where people are kind of on top of each other. You need mass transit to get to. You have a lot of common areas. You're riding elevators. So we're seeing some pain in that segment and not necessarily a lot of distress quite yet, but that may be coming. And if and when that does happen, I don't know how much of a player we would even be in it, because it's really difficult to predict at this point. We don't have enough information about how people are going to behave kind of post-COVID, or, however, this thing could drag on for a long time.
You weren't really in love with that asset type anyway, right?
No.
Right. I mean, I don't think that you were ever bullish on, I mean, not necessarily saying, hey, there's gonna be a pandemic, but it wasn't really. It is a little bit more. It can be a bit more volatile, right? Sort of downtown.
It can be more volatile, and it's more management intensive, right? Because you have the leases, and then the tenant improvements are really where you can get hurt. And this is where a lot of, I think, private investors don't appreciate some of the dynamics of office, and specifically those tenant improvements can be difficult. And that all said, there are good office deals, but they generally are very much more specific. You can understand the demand for that particular office, such as there's some good flex office deals that we've done recently where they're not necessarily large type corporations or law firm type tenants. I mean, they're more, a FedEx office or something like that, right?
Sure.
So there's those two. I mean, we have always liked and continue to like multifamily. I know that's kind of always been one of the top um, assets of interest to our investor base and most around the country. It's easy to understand the demand drivers and supply for multifamily, to pull comps and rents and kind of see what drives those assets. So like multifamily quite a bit. It's priced pretty high right now, so it's hard to find deals that we like. But we are finding some, and specifically when I say that, I'm talking about things that were built to be multifamily from the beginning, and they're generally stabilized. We can go in, add some value to them, increase the rents a bit. They've been mismanaged or whatever the case may be. We really like that space. But again, due to various dynamics, one of which being really low interest rates, it's priced really high right now. So hard to make the numbers work on some deals. And a lot of it's just happening due to financial engineering through low cost of debt.
Right.
So there's that. We really enjoy one of my favorite strategies at the moment that we're really active in is buying distress hotels and then converting those into multifamily. We started doing this in 2018 with a sponsor of ours. And that the numbers on that work really well. If you look at just macro, situations, supply and demand situations, it makes a ton of sense. You have hotels that, especially because of COVID or even a lot of times before COVID, were, they were being bled for their cash flows and the money wasn't necessarily going back into them. They're generally well located. They're built to, house people, even though a lot of them don't necessarily have kitchens, but the longer term stay ones do. So because of those dynamics, you're able to buy those at really inexpensive pricing. The conversion process can be relatively quick. You, of course, need to watch out for zoning concerns. And then lease those out, and the rental rates that we're able to put those on the market are generally toward the bottom of the market, but you have what feels and seems like a brand new product and good amenities. And there's a housing crisis around the United States, so there's big demand for affordable housing isn't the word that people generally use anymore. It's more workforce housing.
Yeah.
But that lower cost housing is in high demand. And so those deals, the numbers work extremely well because of our cost basis, the timing, everything else. So I like that strategy a lot. Another one that is kind of a hot strategy and again makes a lot of sense is a build to rent, a single family build to rent. So we actually have a group flying into town. I have a meeting here in an hour or so from the East Coast, and going to try and cement this partnership today. Hopefully we can do that. But, the idea that younger families, single parents, even older people, getting a mortgage is hard, coming up with the down payment is hard. And then younger people specifically are a lot more nomadic than they ever have been. Yeah. And, they want to own a single family house, but they don't necessarily want to be tied down. They don't want to depart with the down payment, or they can't. So this idea of building new homes that are generally smaller but really nice and decked out, and then renting those. So the strategy is you build them, you rent them, kind of like an apartment unit, but they're single family homes. Again, the numbers work really well, and there's big demand for it just because of the situations of people around the country when it comes to buying a house. So those are some of the strategies. And of course, industrial is another one, and that's pretty straightforward.
Yeah. And I know you spend a lot of time, talking with, maybe more institutional or quasi-institutional capital sources. So is there, I mean, I know that that's what you guys like and are really looking for in sort of building relationships around those strategies you just mentioned, but is there, what is it that the big, more sophisticated investors, what are they out there hunting for? Like, what do you see any trends or themes in sort of their mandate, or what they think they've got to have, or their requirements that maybe you can share with us?
Yeah. Yes. they're after a story, which is what I have found to be interesting. So, most of them aren't all that interested in retail or office, but if there's a story, they'll take a close look at it, and then similar with multifamily, they feel, well, it's overvalued, but if there's a story, we'll take a look. So this concept of converting hotels to multifamily, that's a story. We're working on a deal right now. It is a multifamily product or asset, institutional size, and it is owned by Fannie Mae. It was foreclosed on about 5 years ago, and Fannie Mae has owned it ever since. So there's a story there, and that gets them interested. A lot of them, a lot of the institutional investors seemingly went kind of on pause due to COVID and trying to figure out what their mandate going forward could or should be. And it's a little all over the map. I mean, some are playing the defensive thing and believe that core assets, being the, New York, Chicago, and LA, San Francisco type of assets and their downtown markets is where you want to be, even if the returns are really low. And others are starting to figure out, something that we've always played in this middle market space, like, well, the risk doesn't seem all that much higher or any higher, but the returns definitely are. But, one of the problems the institutional investors have is the dollar amounts are generally smaller than they like to play in. And so that's really, I think, where Fairway America is in a unique and interesting position that, we're higher than the mom and pops when it comes to the size of equity checks we put out. We're usually lower than the institutional investors. And sometimes we go into that space with our check sizes, but there's just this space where the size of the deals is just really fragmented. It's hard for the institutional groups to come down into it, and it's hard for the private investors to come up into it, if you will. And really to put more rigor around that, that's usually equity checks between $4 to say $10 million or so. That's kind of the sweet spot, and sometimes we'll go lower, sometimes we'll go higher, but that's what we're seeing.
So for you guys then, like, what's the like, why would an operator want to deal with you? Because one could say that you're kind of a quasi institutional investor in your own right.
Sure.
And and there are other players now out there. Like I mentioned to you before, I'd interviewed someone from Alpha Investing. Similar sort of. It sounds similar. Cadre, they've raised a bunch of venture money, but when you peel back all of the layers and all the things, I mean, ostensibly they're saying the same thing. So they're saying, okay, we're not operators, but we're going to go find best in class operators, and we're going to partner with them. So what is it that you bring an operator that, obviously the blue blood institutional capital providers don't, and then maybe even what is it that you bring the operator? Because I think it's instructive and helps sort of the passive investor to understand, that being an operator is really, really hard, but there's certain things beyond just the money that add value to them that solve other problems. So maybe get into a little bit of that, because I think it's a lot of times I don't think people completely understand that.
Yeah, and I'll answer it kind of what it means for the investor, right? And so for operators, I mean, it kind of goes back to my story when I'm kind of a bit on my own, being my own sponsor. It's really hard. And so you've got groups from that to even people that have built it out more so and have 10, 20 employees or more, and they're a little bit more polished. The reason that sponsors and operators like to partner with Fairway America is because we do a lot of the heavy lifting on the items that they really don't like to do, and frankly they're usually pretty bad at doing. And because of that combination, these things that are really critical for investors don't get done, or they don't get done well. And I think that creates a lot of stress and anxiety for operators, and ultimately it bogs them down, and they're not able to be as active or operationally effective as they would like. So got my landscapers blowing my windows.
It's COVID, baby. This is all like, I had someone walk in on a podcast I was on the other day. It's like, hey man, it's all good.
Yeah, my dog hasn't barked yet, so we're
gonna
good.
get the dog barking.
But yeah, so there's these pain points that Fairway really helps with the operators, structuring the deals, doing all the legal documents, the offering documents, the marketing documents, raising of the capital. And then the sponsor themselves are really allowed to do the day-to-day execution of whatever that strategy and that asset may be. And then on an ongoing basis, Fairway continues to do, investor reporting and quarterly, webinars to talk through with the investors what's happening on the deal. And then our asset management team is monitoring the deal on an ongoing basis, touring it, reviewing the financials. We have a forensic accountant on staff that's reviewing things to make sure it's all, what it should be. And we often have money invested alongside of them. So for investors, what this all means is that, we're taking individual deals, and these are sponsors that they have to work with Verivest, right? So we know that the accounting and the background checks and everything going forward is going to be done up to what it should be, to the level that it should be. And then for an investor, you're getting our underwriting and due diligence team. We have in-house attorneys, we have in-house MAI appraiser, we have Angie Henderson, our senior underwriter, has been with us over 25 years. You've got Matt, you've got me, and you have, I don't know at this point, another 30 or so employees that are actively involved in the upfront underwriting and then the ongoing monitoring of the asset. Beyond that, as I mentioned, we're putting our own, oftentimes personal money, but also fund money into these deals. And so we have a vested interest right alongside the investors. So it goes both ways. So for investors, there's a lot of value to working with us because you get to see a lot of deal flow. You can invest into diversified funds and just kind of be passive in that way, or you can pick and choose some of these single asset deals that I focus on and try and customize your own unique portfolio. And we have value add and cash flow. And so you can create diversity in your own customized way. And then again, for the sponsors, it allows them to be much more operationally efficient. They can do more deals and therefore, do what they like to do and what they're good at doing, and remove a lot of those pain points. And beyond that, it helps to polish them up, right? If you're partnered with us, then when we go to an institutional investor or even high net worth investors, they're not only looking at that sponsor's track record, and maybe it's a 32-year-old sponsor and it's good, but they've only been doing it for 3 or 4 or 5 years. They get to now lean on Fairway's track record, background experience, our whole executive team, and get that lift behind them as well to help accelerate their own growth.
Yeah.
So that's kind of both sides how we bring the value.
Yeah, no, I think that's a good explanation of it, and I think that's where hopefully everyone can kind of see that's where the synergy exists between like my day job at Verivest and what they do there is, and it's one of the things that came out of it. Obviously, we got a lot of feedback from just sort of high net worth investors, retail investors of like, if I could wave a magic wand, I wish I'd have a background check run. I wish that someone could verify and validate the track record. And I wish that someone not named those people were actually monitoring this because I don't have the time, inclination, or wherewithal to do it. But it also, helps solve a problem that investors like Fairway have, which is conducting the appropriate amounts of due diligence on a sponsor is very time consuming, and it ends up falling on the ledger of the investor in cost of human resources and those things. So I think that, getting the feedback from the retail investors like, hey, we wish we could do this because we can't do it and don't have the time, but also from more professional investors to say, hey, shortcutting the time to trust is good for people like Fairway too, just like it is for a retail investor, because now Fairway can say, listen, we're focused on, we want to have certainty of certain things before we dig in, because there's plenty of, operators out there. And I think that that's another thing. It's just, it's very symbiotic, right? This whole thing is that it helps all the constituents of the ecosystem. And then, of course, bringing sort of that institutional rigor on the financial side and sort of the compliance side. That's what we do at Verivest. But you can see on the flip side, taking that on the deals that you guys have sort of passed your muster, and the sponsors that have passed the muster, and then adding really institutional quality reporting. And then, like you said, the asset management side too. So oftentimes when they're busy in execution mode, having people who are kind of there overseeing it down at that asset level to make sure, we've even seen that. We've caught things, on the monitoring side where some property manager is overcharging. Once again, it turns out in the end, it's not like they were trying to be malicious or committing fraud or whatever. Was just like they were making a mistake and it didn't get picked up. Yeah. And then we pick it up. But it's the same thing on your side. It's just making sure that like everything is buttoned up here. And, in the spirit of this being the real estate risk report, like that's ways that you mitigate risk, right? So these are all risk mitigation strategies. So when you look at, the risk that you're pregnant with in the absence of these things, and if you could put, a basis point, what is the risk premium that should be attributed, in my opinion, as you and I have had these sorts of conversations for years, but I think it's a hell of a lot higher than people realize, right? Like that, they need to price that in, that if those things aren't in place, it's expensive. There's a lot more risk that you're taking on. When you can eliminate that to where you don't need to put a premium on those things, which is all the stuff that you're talking about and that I talk about, it does protect your downside. So, those are the things that, as you as an investor, an individual investor, want to be thinking about. You want to be trying to check as many of those boxes to, eliminate your downside risk.
That's right. And I was thinking about all of those points kind of in preparation, knowing we were going to talk today. And I completely agree. And this pressuring me, like, why is the return that you're targeting only this? And it could be higher, and it should be. And this other group does higher return. And I'm like, well, I mean, look, I can deliver higher returns, but it's going to increase the risk tremendously, right? And it's hard to see those nuances of where each individual risk thing is that, creates, in theory, higher returns, but also eliminates a lot of your downside protection. Yeah. And I think you just called it being pregnant. And I think, also thinking about some of the things you and I have witnessed over the years, like a lot of investors think, okay, I'm investing in, let's just say, a deal with this sponsor. And so here's my $100,000 today. And I'll just sit back and, 5 years from now when they sell the asset, I'll get my money back. And that's just not a very good way of investing, right? Because things change. And even though you might be locked into that deal, you should be paying closer attention and or have a group like Fairway, or in Verivest's case, Verivest watching that sponsor, Fairway watching that deal. Because as you and I have seen, we've seen sponsors that were seemingly perfectly legitimate, 7 years ago, 6 years ago, 5 years ago, and then all of a sudden they deviated off of that path, and investors didn't pick up on it until it was too late. And a lot of times you've seen this also, Lance, that, Fairway had investments into various funds, and we've kind of we'd still have some, but we've backed off on that quite a bit. And a lot of it is because, some of the sponsors, you could feel certain things, right? And that's why I love what Verivest is doing on this ongoing monitoring, because just because someone is good today doesn't mean they're going to be good tomorrow. And deals are similar. The deal might be good, and even if everyone has their absolute best intentions and does everything, up to board on, executing, things happen. Hurricanes happen, fires happen, things happen, and you want to make sure that as an investor, you're aware of those things happening sooner than later. And that doesn't necessarily mean you can do anything about it sometimes, but you can at least kind of be the squeaky wheel to make sure that someone's paying attention.
Yeah, that's right. I call that, there's moments of truth, right? And
right.
Obviously our axiom is, trust but verify. Of course it would be, right? Blindly trust in this business. There's plenty of things you can just, be very trusting. And I think as humans, we generally are, trusting and trustworthy of others. But in the investment business, trust but verify. But it really does come down to these moments of truth, as you're talking about, occur. And it's sort of a fork in the road for, the person in charge, and they have to make a decision. And unfortunately, as humans as well, we confront those things, and many of us aren't as courageous as we'd like to believe we are, right? It's easy to think we will be, right? And so, and I know for me, like I know that I'm not. I know that I'll charge into fires and do things, and hey, I also know how hard it is when that moment of truth occurs to do the right thing, right? Because it's pulling you apart, and you want to run and you want to hide and you want to stick your head in the sand, and that's just human nature. And so
that's right.
I think that by having these forcing functions, whether it's Fairway as a more sophisticated partner who's paying attention, and therefore you got to do the right thing, or Verivest is sort of your monitor who's going to ask those questions like, well, why did you do this, or where did that money go, and why are you doing that? It forces you have to choose the right path. In fact, one could argue it's sort of that the other option is sort of boarded up and blocked. And but that's how it works in investing, and that is what's missing in the private markets, up to this point, and that is that opaqueness. It's that there is no one watching. They don't have analysts like they do in the public markets who are scrutinizing every little thing, and that doesn't exist here. I mean, this is what we just described, I think, is the closest thing that does exist. And I'm a firm believer, like I'm a free market guy, as you are as well. And so, but at the same time, being in the private sector, I get how these things work. If we abuse the privileges and powers we've been given, then the governments are forced to regulate us, to regulate whatever it is. Right. So my stance is that I like the freedom that we have. That's why I love this country. Right. But I certainly I don't want to abuse it. I don't want to let others abuse it, so that then all these other regulatory regimes, well, not to mention it increases taxes because we got to fund these deals and all this sort of other stuff, the knockoff effects of it. But that's what can happen. Right. And so now it's a beautiful thing. Access is increasing for every, Joe Six Packs of the world and Joe Dentist and every man, right, to have access to these things, right, to generate alpha and to build their net worth and those things. But and that's what the lack of regulation at this point, meaning it's become more favorable and allows you to sort of transact, and capital formation is easier to do than it used to be pre-Jobs Act and things like that. But we have to be good stewards of what the privileges we've been given in this regard, right? Because if we don't, and we start to abuse it, then they're going to start to come down hard on us, and all it's going to do is hurt those same people that everyone's working so hard to benefit, which really is, the everyman, right? Yeah. That's what everyone says. All the rich, white guys are getting richer and richer, right? The rich get richer, and everyone keeps saying it, but this is the way that we start to counter that, is let more ordinary people get access to these things, assuming they're educated and understand these risks. That's why I do this. It's like focus on the risk, educate yourself. You don't want to be ignorant, but I think that's what this is all about.
Yeah, no, absolutely. Completely agree with all of that. I mean, it's important, and you're right that there are these moments of truth that as a fund manager or an investment manager, there are times that you have to communicate something that's not fun to communicate. Like, even during COVID, pandemic happened, but we had to communicate to investors like terms this quarter are going to be low. Yeah. And partly because we're going to hold back loss reserves, and this is the best thing for you, and this is the right thing to do. but delivering those messages, it's not fun. And I think a lot of people don't do it, and they shy away from it. And then investors are kind of in the dark, and then it snowballs from there, right? So I think that, finding sponsors that understand some of those things, managers that, will deliver messages that aren't necessarily fun is important, and communicate clearly, and, don't get blinded by returns or flashy marketing or slick talkers and all of those sort of things. Just, find where the risks are and make sure you're comfortable.
That's right.
with the people you're
cool. Well, this
with.
is a good talk. I mean, of course I knew it would be, because you and I always, would like to talk about these things. So now the rest of the world gets to hear what Darris and I talk about when we play some golf together, or whenever we do see each other. So where can people find you, Darris? So how can they connect with you?
Fairwayamerica.com is the website. You can email me, Darris, which is DARRIS, Darris.Cassidy, CASSIDY, at fairwayamerica.com. So Darris.Cassidy.
We'll let you run, and you can go close that deal with that build to rent. Yeah. So good luck on that one.
Yeah.
Right,
yeah.
Take
cool.
care. See ya.
Thanks, Lance. It's been fun.